Good morning, everybody, and welcome to today's meeting of the Local Pension Committee. As usual, this meeting is being broadcast live to the public. For those not able to watch live, the webcast will be recorded and be made available for viewing on the County Council website after the meeting. Before we begin, can I please remind everyone to turn on their microphones when you wish to speak, are invited to speak, and turn them off as soon as you've finished. I note we've received apologies from Councillor Whittle, Clive Pitt, Mr. David Bill, Martin Cartwright and Phil King. Mrs. Maggie Wright is present as substitute for Mr. King. I also know that we have Vipul Bashar with us online. He's not online at the moment, is he? No, but he will be hopefully in a moment. Before we move on to the main agenda, I would like to take the opportunity to recognise the contribution that Philip Pearson from Hymans Robertson made. He's been advisor of the committee since 2021, and I'm sure all members would join me in thanking Philip for his services and extending our best wishes to him. We have with us this morning Richard Lunt and Russell Oates from Hymans Robertson, and they will be speaking later, so welcome to you both. The first item is the minutes of the meeting held on the 29th of November 2024. I propose the minutes of the meeting held are taken as both confirmed as filed. Is that agreed? Yep. So, item 2, question time. I've received no questions. Item 3, questions asked by members. I've received no questions. Item 4, to advise any other items which the Chair has decided to take as urgent elsewhere on the item. I've not been notified of any urgent items. Declaration of interest in respective items on the agenda. Does any member have any interest they wish to declare? No? No. So no interest declared. So the first substantive item on today's agenda is the Fit for Future consultation responses at pages 15 to 34 of the agenda. Simone Hines, Assistant Director of Finance, Strategic Property and Commissioning, is introducing the report. Over to you, Simone.
Thank you, Chair. This report is just for noting because it's a consultation response that we have already submitted. But the Appendix A to the report, you have got a full copy of the Fund's consultation response to the Fit for the Future consultation. The committee did consider the full consultation proposals at the last committee meeting back in November, and we took the feedback from that discussion and from the committee to make sure that the response included the views of the committee. And as you can see in the appendix, we have then included those in the response. And you'll see that the response is largely supportive of the proposals, which again is in line with the discussion last time. It does recognise the benefits of pooling and the benefits that we've already achieved from pooling. But it does also raise a number of challenges that the Fund sees with the current proposals as currently drafted, and some suggested solutions on how to deal with some of those challenges. We've highlighted those in the introduction to the response, which also I think is on page 20 of the pack. One of the main suggestions that the Fund's put forward is a request that fiduciary duty should be extended to pools as well as administering authorities, and that funds should retain a remit to set both high-level investment objectives as well as the strategic asset allocations. There's also a concern around how the legacy assets would be transferred, and want to make sure that they're done in a sort of safe and cost-effective way as well. So whilst we are broadly supportive of the proposals, there are some elements that we wanted to make sure were considered by the government in terms of how they wanted to move forward with any proposals. The consultation closed a couple of weeks ago. We haven't got any sort of timescale in terms of how the government may respond to those or how they may wish to move them forward. But we'll obviously keep the committee up to date as we learn more. And that was all. Obviously, happy to take any questions.
Thank you, Simone. I think the response actually highlights the concerns that were raised by the committee, and it's the response is fairly detailed and a lot of common sense in there. We'll wait to see what the result of the government's response to the consultation is. Does anyone have any questions or comments that they want to make? Nick.
Thank you, Chairman. Just in terms of what you said, Simone, totally agree about fiduciary duty. That's absolutely fundamental with a pool, because what's the end game of this? Is it to make things more efficient, which case can't really argue too much against it? Or is it actually they want to grab all of our resources and use it for whatever they want? And that is absolutely totally against that. So that is absolutely fundamental to make that very clear, that this is the members' money and the councils who've put money in or whatever within that. It's not for the pet schemes. I wouldn't want it spent on HS2 or New London Airport or whatever. You know, that is not what these funds are there for. It's to pay the pensions of the staff and the members of the fund. So that's all the comment I've got to make. And I think that's absolutely fundamental. It has to have that fiduciary duty.
I certainly wouldn't disagree with any of that. I think it's absolutely vital that we retain focus on what pension funding for. It's to pay the members' pensions, and I can't say anything further than what you said, Nick, on that. Any other comments or questions? No? Right, so the committee is recommended to note the report and the responses to the local government pension scheme Fit for the Future consultations as set out in the report. Is that agreed? Agreed? Yeah, that's unanimous. So the next item on today's agenda is the overview of the current asset strategy and proposed 2025 asset strategy, which is reported on page 35 to 112 of the agenda. Bullish Carter, Senior Finance Business Partner, is introducing the report. And as I said, I would like to welcome Richard Lunt and Russell Oates from Hymans Robertson. But initially, over to you, Bullish.
Thank you, Chair. I'll introduce this before handing over to our colleagues from Hymans. Running through the purpose. So the purpose is to inform the committee of the outcome of the annual review of the fund's strategic investment allocation and structure. I'll cover off a few items before letting Richard start on his presentation. It's also important to note that the report takes into account the ongoing Fit for the Future pooling consultation. We've got a slightly longer background than we normally have on this paper, so I'll run through a few points here to kind of frame what you're about to hear. So we've got points 4 to 14 to do that. So a quick reminder that the nature of the fund's liabilities are long-term. The strategic investment benchmark focuses on the need for long-term returns and a degree of inflation-linked returns. Market fluctuations will cause the fund's asset allocation to vary from the strategic asset allocation. We've seen this over the past couple of years. Investments, for example, within private market asset classes create further variation as capital is added to new products and return from existing products where the timing of capital flows is uncertain. However, the fund has improved its funding level over successive actuarial valuations. The last valuation, as at the 31st of March 2022, showed a funding level of 105%. So that's for every pound of liabilities, we had £1.05 of investment assets. The equivalent funding levels as at 2016 and 2019 was 76% and 89% respectively. We had an update at the LPC meeting on the 6th of September 24, a mid-valuation funding level, as we called it, and was performed by the fund's actuary, also Hymans Robertson. It's not a full fund valuation, but it's more of a guide of where the funding levels might be, where the valuation was to be carried out at the 31st of March 2025. The funding level guided to at that point was about 150%. The actuary did urge caution, given the fund holds a similar amount of money to pay each pound of pension as they did at the 2022 valuation date. The improvement in the funding level has largely been driven by an improved investment outlook due to a rise in global interest rates. And that leads to higher expected future returns across all asset classes. It is important to note that the future investment returns are not guaranteed within the backdrop of higher interest rates, i.e., higher interest rates do not guarantee higher or even the same positive investment returns into the future. Points 8 to 11 talk over our involvement with LGPS Central. I'll quickly go through those. So Central's product offer continues to develop. This year's strategy has been undertaken with this in mind, just in the same way as previous years. We have shared our strategy with LGPS Central, and we do take into account the anticipated pooling changes within this strategy. Pooling of the fund's assets has resulted in Central becoming our largest single investment manager. As at the 30th of September, the fund was valued at 6.5 billion, with 2.6 billion, so that's about 40% of our total assets within Central's investment funds. The fund also holds 1.1 billion, or another 17% of total assets, with Legal & General's investment management's passive equity funds, which were collectively procured by 7 administering authorities, ourselves included, at favourable management costs. Take those two together, about 57% we class as pooled. In addition, the fund has made significant commitments to Central private market investment products, which will be called over the coming years. The value, as at the last update at the November committee, was about another 760 million, is uncalled in commitments to Central investment products. 12 to 14 talk to setting of the strategic asset allocation. Any decision on the appropriate allocation is naturally difficult and will hinge on a trade-off between expected risk and return. Whilst historic measures for risk and return can be informative about how different asset classes correlated to each other, they don't give any guarantee that these links will persist. 13 talks to 2022 and how this was a reminder that those previously held beliefs aren't proven to be true in every case. We saw both bonds and equity sell off at the same time. Moving over to point 15, this part is loosely covered by the Hyman's PowerPoint, but I'll quickly go over this. It's a review of last year's strategy proposals and the progress made, covered in points 15 to 19. So firstly, no changes to the asset allocations were proposed by the fund's advisor as at the January 2024 committee. However, a number of asset class reviews were recommended. Firstly, a protection assets review was recommended, and that was presented to the ISC in May of 2024. And it covers the 4 mandates that are listed in that table there. So index-linked bonds, short-dated corporate bonds, investment-grade bond fund, and the active currency hedge, total about 8% of our fund. And the point of the scope mainly was to cover the 7 areas which are listed at point 16. Should the allocation of protection assets be increased, and what level of protection assets best supports the aim of maintaining a stable, lower level of contributions over time? The outcome concluded that the results of the work completed in that paper doesn't provide a compelling case for increasing the weighting to prefer protection assets at the time. We've got a number of bullet points at point 18 there if you wanted to read or ask questions on those. We had 2 more reviews planned through the year. So after the protection assets review, we had a review for maintaining exposure to asset classes which would be returning capital through 2024. Bank risk share, or bank capital relief as it's known, and Timberland were also concluded through the year. So the fund has a target allocation of 2.5% of total assets to timber. The review was presented to the 24th of July committee meeting, and it was concluded that the fund supports the current Timberland manager, that's Stafford Capital Partners' proposal to create a continuation fund in order to avoid selling down Timberland assets and existing investments in closed-ended funds, which would then return capital to investors. So the point there was we have investments in 3 closed-ended funds. They'll be returning money to us. The manager thought it would be a good idea to create a continuation fund so they wouldn't have to sell down those assets, then have to raise a new fund, i.e. keeping the really good assets. That proposal was supported by the existing investors, and those vintages known as 5, 6 and 7 will be rolled into this continuation fund. The second review was to the bank risk share or bank capital relief, and that was presented to the October meeting of the ISC. That allocation forms part of the private credit allocation and has a target weight of 10% of the 10.5% of private credit, so roughly about 1% of the total fund. The existing allocation is to 2 vintages from a manager called CRC, or Christopherson Robb and Company, We've got investments within Credit Relief Fund 3 and Credit Relief Fund 5, which are both returning capital. Hyman's considered 2 other managers in that space and proposed that it be appropriate to continue to allocate to the current manager into their newest offering, Credit Relief Fund 6, pending any legal due diligence, which is still ongoing. The rest of the paper talks to the actual investment strategy review, and I think it's probably a good time to then hand over to our colleagues if there's, unless there's any other questions.
So, has anybody got any questions? No. So over to you then, Richard.
Thanks, Phyllis. Firstly, I'd like to thank the committee for the words about Philip Pearson earlier. I will make sure they get passed on to Philip. Just to introduce myself, my name is Richard Lunt. I'm an investment actuary, investment strategy specialist. I'm authorised by the FCA to give advice, and I have been for the last 20 years. Russell can introduce himself separately. He's another investment actuary, and we worked together for the last 10 years. I'm just going to go through the presentation deck, which is about to appear. Fantastic. Okay, thank you. So this deck is a summary of a much longer slide deck. I'm focusing on the key areas with some relevant background, and I'd welcome any questions or interjection at any points in the presentation. The first thing I should say is we were halfway through the strategy review. Based on the previous environment for advising LGPS. And we had a meeting updating the officers on the direction of travel, and then Mansion House and the consultation landed. Just to reassure everybody, it was pretty obvious that some of the direction of travel prior to the Fit for the Future consultation was not consistent with where the government is going. So we've effectively rewritten quite a lot of our advice to make sure that what we recommend is consistent with the consultation. The consultation will appear later this year. We've effectively recommended a few initial steps, which we'll talk through, which will be consistent with the proposed consultation. And then later on in the year, depending on how the consultation lands, there's a few other areas to look at. So all of this is consistent with the direction of travel. This is the executive summary. So there's a few things we're recommending today. If you've got a pool of money of this size, you're going to see quite a few different investment classes. All of these investment classes, I'm sure, will be familiar to you. I've seen rather a lot of pension pots over the past 25 years or so. This focuses on what I would consider to be the key long-term asset classes. So this is simpler than some of the other funds that you see around, and it focuses on the main classes. A key long-term investment class for all of the LGPS is listed equity, which is stocks and shares. You will see towards the top of the table, there's a sort of that's a yellow sort of oval shape over the listed equity. There's also highlighted is the property allocation and also the global equity, the global credit private debt. These are effectively areas where we're making a recommendation that we'll talk through today. One of the key ones is the listed equity. We've got a few more slides on this later on, but this is actually a good news story with this portfolio. Around about 40% of the 6.5 billion are invested in equity, and this class has performed tremendously well over the past couple of years. In the US in particular, this class has done 25% in the last year. And what that has led to is an overweight position in stocks and shares. Now, there's a few different options here. You could sell 300 million or so of equity to scale back to the default position. What we have done is consult our economists. In our view, the long-term prospects for equity remain intact. We think the class is fair value, and we don't think it's necessary to incur very significant transition costs by selling this class down. I'll come on to the rationale a little bit later on. But in summary, we're suggesting if you look at the listed equity element, the current allocation is 43% of the fund. The target is quite a bit lower than that, it's 37.5%, and we're recommending that the target is restated to be 41%, which is closer towards the current allocation. And I will cover the property and the global credit separately. So any questions on that before I move on?
Presumably, if I may, Richard, so presumably the increase in the asset value has caused the percentage of our listed equity to go up. The value has gone up.
Yes, it has performed very well relative to some of the other classes, in particular the bonds.
Yeah, I get where we're at in terms of the listed equity. The question I've got though is in terms of this. Isn't this a bit too simplistic in terms of listed equity? Because haven't we got beforehand? We had US, UK, emerging markets or whatever, and I think that they need to be considered separately in a different way rather than just as one block as listed equity in terms of asset allocation.
Yeah, that's a very good point, actually. We cover that off on point 24 in the paper. So we have only 5 funds now. So you might remember a number of years ago, we had LGIM managing a bunch of our passive assets, but we had regional allocations to Japan and emerging markets, North America, Europe. And what we've done is we've slimmed down that portfolio into just 5 holdings. So we now have a central global equity, so effectively covers the whole world. We've got Central's Climate Multi-Factor Fund. We've got LGIM's 7 or 8 funds slimmed into 3. So we've got a UK equity holding from LGIM, very cheap. We've got LGIM's global equity holding, and we've got LGIM's low carbon transition fund holding. So just the 5. And at point 24 in the paper, we can see where the holding should land. So Central's global equity fund, a 12% holding. Central's climate multi-factor fund, 12% holding. The low carbon transition fund from LGIM, 3.5%. LGIM's UK equity, 2%, and the remaining element up to 41% is 11.5% to LGIM's global equity fund. So we do have a target allocation bit within that 41.
Okay, Roy.
Yes, I think it's very important that we know the geographical split of these investments with geopolitical upheaval that we've got at the moment. I'd like to see whereabouts in the world our money is. So I think that's a good point made by Nick.
Thank you. Thanks, Roy. James.
Thank you. Building on a similar theme, I think two slightly different questions. So within the US, for example, I think a lot of the growth has been driven by the Magnificent Seven, and it was, I guess, a question below almost like territory. Is there any kind of specific action? So not necessarily changing the overall metric, but to manage some of that risk within. I guess that's question 1. And then secondly, slightly different. We mentioned in terms of the risk around equities being no change to that risk. And I guess when we start to think about the valuation, we've kind of considered slightly different kind of risk on that side, and we've kind of said it's in a really strong position. Do we need to start doing things differently? So I guess just triangulating our thought process on risk from both sides of the coin. I think.
Really good questions. Just on the first one, the equity is spread largely amongst the developed markets. The largest economy in the world is the US, and that is reflected in the portfolio. There's also material allocations to the UK. The makeup between the individual geographies is considered from time to time. That information is available. I don't have it to hand, but the allocations look consistent to the other LGPS funds and what we would see typically. On the risk point, investing in different geographies only protects you to a certain degree. The largest companies in the world are global companies. And I'll give you an example. The UK, the FTSE 100, 3/4 of the revenue actually comes from overseas. They're all intrinsically linked to the health of the global economy. If there's a global recession, they will all fall at the same time to a broadly similar amount. I've got on the risk point, which is a very useful point. I've got some numbers a little bit later on. It's very important. I'm glad you asked this. Actually, it's very important for the actuarial valuation that the expected return from the assets is high enough to make sure that the sponsor contributions are of an appropriate level. And it's very important to make sure the risk associated with this strategy is not too significant. That's how you get hurt in a recession, when you run too much risk. I'll come back to this a little bit later on, but I think it's important to say at this point that the proposed target, we run this through our models, and both the expected return and the risk is comparable, actually very close to the current strategy. So this does seem to hang up from both an economic and a risk perspective.
Okay, thank you, Richard. Any other questions? No? Okay.
So just going through, the key recommendations are some modest, I think, relatively speaking, modest adjustments to the strategic allocation. There is a question that is being asked by a lot of the LGPS. If the US equity market goes up 25%, largely driven by the Magnificent Seven tech stocks, is there a chance that the good financial position that I will show you in a minute could be lost if there is another recession? The answer to that is it could happen. And at the final part of this presentation, we're going to recommend that you consider ways to protect yourself in the event that there is another global recession which hurts equity markets, given that there's been 3 in the last 20 years. We're also going to touch upon a couple of other classes. Property, I've got some slides on. I'll come back to that a little bit later on. But that class generally has struggled post-COVID with people working from home and retail difficulties. But I will come on to that. And we've also got a session on global credit. And these are the areas where we'll ask recommend action. Now, I just want to say at this point, I've advised quite a lot of arrangements over the years. The bottom right-hand side is unquestionably a good news story. And Bhulesh said earlier on, I think 9 years ago, that the funding position of this arrangement, I think it was 75 or 76%. If you go back to 2022, it was 105%. And the estimate last year was at 149%. This is a significant success for the investment portfolio. There's obviously a valuation around the corner, and quite a lot can happen with the equity market and the liabilities before 31 March. But as we sit here today, this arrangement is in a good position. So this is why we've suggested, in the event that we have another credit crunch, dot-com bubble, COVID shock, it might be worth getting some protection in case the position deteriorates, because this isn't something that you would want to lose. It could lead to higher sponsor contributions in a very severe recession. Is there any questions on that before I move on? So on to the individual classes then. I'm just going to pass over to Russell, who will briefly introduce himself.
Good morning, everyone. I'm Russell Oates. Been in the industry about 18 years or so, something like that. Been involved in this arrangement for about 15 months or so, so some of you might recognise me from past meetings, but good to see you all. I'll just briefly touch on progress made last year. Bhulesh has already touched on a couple of these areas, so I'll keep it quite short. But in summary, the officers have been very busy throughout the year with a little bit of our help. So touching on a few areas, the equities have been restructured. That took place over a few tranches over time. That's now complete. Noting the addition of, for example, the LGIM Low Carbon Transition Fund. And we'll come back to responsible investment and the progress made there later on. We carried out quite a comprehensive review of the infrastructure portfolio over the year, concluding that we like the class, we're happy, we're comfortable making more commitments in that area. And worthy of note there is the extra commitments going to LGPS Central. So again, we'll come back to pooling and the direction of that, but noting the additional support and commitment there to the pooling cause. We carried out the bank risk share review, over the year, where additional commitments were made to the CRC manager, as noted earlier. Some progress made with adding to MAC, or multi-asset credit. Again, I'll return to this shortly, but progress there temporarily paused for what we think is good reason. And again, on the right there, another comprehensive review, this time of the protection assets, concluding we didn't think there was a strong case for adding to the traditional protection assets such as bonds, government and investment grade credit. But one thing we noted in that review was that one thing that could really hurt you was a very big fall in equity markets, in listed equities in particular. And if that happened at the wrong time, for example, just before evaluation, that could really cause a problem, which is why we're suggesting what we're calling a tail risk protection review, and we'll explain what that is shortly. Skipping over the page, so going back to the pooling progress. So just to note, this is a kind of pre-consultation position, if you like. So there's a comply or explain requirement by March 25, and as demonstrated here, we think there's been really good progress on pooling to date. 57% of assets landed in that what we call category 1, which is already pooled. In effect, this is good progress, we think. Of the remaining assets, we've broken those down into 2 categories. One which could conceivably be pooled in the near future. For example, investments which are closed-ended, effectively waiting for proceeds to be returned, and then they could be recycled potentially into pooled products. The other category 3, ones which it would be a bit more difficult to pool. An example of this would be, for example, the CRC investment we mentioned earlier, bank risk shared. There's a few areas of the portfolio which are useful to have in there, there's a good investment case for, but Central don't offer these things as yet. There are plans to discuss these things with the pool over the coming years, but at present you can't get pooled investments in these areas, so that's why they fall into this category. And then just to note that the consultation changes this position slightly, in that if there is a requirement to pool all assets by March 26 as planned, then effectively we'll have to find a way to make those category 3 assets, category 2 assets, and pool in short order. There are probably ways we can do that. For example, transferring ownership to the pool of existing investments. So in summary, very good progress made to date. The consultation might change things in terms of the direction, but we're already thinking about ways that can be done.
Okay, thank you. Thanks very much. Any other questions or queries on that? No? All right. So,
Over to Richard.
Richard.
Thank you. So I promised I would come back to one of the decisions today, which is not to sell several £100 million of equity and incur the transition costs. The rationale for that is twofold. Firstly, I was actually just going to remind everybody what listed equity is. This is stocks and shares. So you can buy GlaxoSmithKline, for example. You will get dividends. You will hopefully get capital growth from the investment over time. This over a 10-year or 12-year or 15-year period, the expectation is that equity will give you a significantly higher return than, say, bonds. And almost all of the LGPS lean pretty heavily on this investment, and we're very comfortable with it in the portfolio. The question is, do you trim the allocation based on the very strong performance over the past couple of years? There's 2 things we've taken into account. If I just skip onto the next slide, this is probably the best way of explaining it. The first thing we've done is we've considered the views of our team of economists. And equity is very sensitive to broad economic growth, which nowadays is pretty highly correlated across regions for the reasons that I mentioned. The top left-hand side here, you can see the GDP growth of various countries around the world. The US has been doing pretty well. You can see that this is one of the reasons why the US market has performed so strongly recently, partly driven by the tech stocks. And you can see the forecast is for there to be positive real growth in the major domestic economies. There's no such thing as equity market conditions that don't have risks. There are some risks. We've already mentioned the tech stocks doing so well recently, and we've got Donald Trump in the US. There's two aspects to Donald Trump with regards to the global economy. He's considered to be very business friendly, low corporation tax, and encouraging US investment in particular. That supports markets. If there are trade wars due to tariffs, and if there's low individual taxation in the US, both those things are inflationary. So as I say, that there's various things in the melting pot. In the round, however, our economists think that the long-term prospects for equity are good, and we don't really see a case for selling a lot of equity at the current time, subject to the overall allocation being within a tolerable risk range. And I will come back to the modelling later, but in summary, we are happy with the prospect for equity markets. Is there any comment on that? That's quite important to our presentation.
Roy.
Funds.
So we've got a combination. So we've got the LGIM funds, so the 11.5, the 11.5, the 3.5, and the 2. So that's the low carbon transition, the global equity, and the UK equity. They're passive, so they'll just cover off, whatever the index weights are for those markets. The global equity at Central, 12%, wholly active. So managers can choose exactly where to be underweight, overweight. The climate multi-factor fund, we kind of say, is kind of semi-passive, but more passive than not.
James.
Yeah, this does make me a little bit nervous, I think, because it's obviously such a sensitive area. But in terms of that, the sensitivity, so several £100 million in terms of the fees, and that's a big number. But is there any idea of the sensitivity? What would that mean in terms of 1% decline in shares, etc.? Do we have a view of that?
There's different ways of expressing the risk. A deterministic stress test of the type you describe is one way, which is a valid way of doing it. The way we happen to have characterised risk is based on a summary risk number that I will share with you a little bit later on. But in summary, the current portfolio in the round, taking account of the risks of all the individual classes on the diversification benefit, has a certain level of risk, which I will show you. What we're recommending is you ratify a slightly overweight equity allocation, which will add some risk. And we're suggesting you ratify a slight reduction to the property allocation, which is a growth asset, which reduces risk. In the round, the risk is the same post our recommendations as was agreed last year in a pretty comprehensive review. So there's no increase in risk.
Okay, thank you. Any other questions? Richard, have you carry on?
So that is one of the most important points. We have a slide on each asset class here. I'm just going to focus on the more material ones, if that's okay. But any questions, please interject. Private equity, that's investing in good quality companies which don't happen to be listed on the stock exchange. An example is Lego. You can't go and buy some shares in Lego. Mars is another one. You can get good quality private companies, and if you're a long-term investor, and you can accept the illiquidity, you can actually get a materially higher return from this class. This class has performed very well. There's a plan to redeploy some of the cash in order to top up the allocation to private equity, and we're very supportive of that. And there isn't anything else really to draw to your attention here, unless you want some additional detail.
Any questions, further question? No? Okay.
The targeted return, this is for completeness. This is a relatively modest proportion of the portfolio. Is it 4% or so? 5% of the portfolio, and this is a diversifier. This is a different style of investment. The fund managers are multi-asset. They, unlike the work we're doing today, where every year or two we recommend a difference in allocation, the fund managers, and there's two of them, can be very nimble. They can overweight equity, they can overweight growth bonds, they make day-to-day decisions. In short, we're comfortable with both the managers. One has performed very well, one less so, but that's the reason why there's complementary fund managers in here, and we recommend this is left to run for the coming years, and then you can review maybe in 3 years' time. But it's 5% of the portfolio, just to put this into context. So if there's no questions on that, I can move on to an important.
Carry on.
Yeah. This is the area I wanted to draw some attention to. So the other two classes we've just looked at, there's no recommendation to adjust the strategic allocation. There is in property. This is a very interesting class. It's commercial property. It's a combination of the UK and global investment. And this class, which covers offices, retail warehouses, shopping centres, has struggled in recent years. There's a few reasons for that. Firstly is COVID, and we all know the impact that has. If you go to a shopping centre, quite a few major shops are not there anymore. Also, COVID caused problems with offices because quite a lot of people work from home quite a lot nowadays. Another problem that this class experienced is the very high gilt rates in 2022. I'm not going to go into detail about this, but there's an asset class called liability-driven investments, which needed a lot more money a year or two ago, and a lot of private sector schemes needed to sell property, and quite a few of the major UK funds, for example, and BlackRock, have got multi-hundred million pound redemption queues. So in short, just like the equity, we've asked our economists for the view on this class, but we've got a slightly different answer. So the question here is, do you want to top up to the tune of 2.5% the property allocation, which again is in the hundreds of millions of pounds? But the recommendation here is based on the views of our economists. We don't think it's a good time to go into property. There's a few charts here that I'll just touch upon. There's a lot more detail than we've put in here. But possibly the key chart actually is on the top right hand side. And if you look at the red line, that shows the yield you're getting for property over and above what's called the risk-free rate, which is the government bond. And since the 2022 crisis, you can see effectively the return that you're getting relative to the government bond for property is a heck of a lot lower. And in the view of our economists, that this isn't a class that you really want to incur very significant transition costs going to at the current time. So this is the second of the recommendations. Restate the property allocation. The target is currently 10%. If you restate it to 7.5%, which is close to your current allocation, that makes sense from both a risk analysis point of view and the views of our economists.
Questions on that? No? So
Okay. It's economics heavy today, isn't it? I'll just pass this over to Russell.
Yeah, so just continuing through the asset classes, infrastructure, I'll spend less time on just because, again, no recommendations here at the present time. As I say, a comprehensive review carried out in 2024. We were comfortable with the class. We've made additional commitments, phased commitments to our GPS Central over the next 2 or 3 years. So I'll not spend too long on it. As a class, it's investing in physical assets that offer critical, that fill a need in terms of critical services. So this could be anything from sort of roads, bridges, airports, renewable energy projects, water systems, all sorts of different areas, things that the economy needs to, that society needs to function. It aligns very well with the pension fund such as this. It's long-term, often inflation-linked returns, good income prospects, and at the same time provides, as well as sort of the economic side, it also provides social benefits in a lot of cases. So very good class to have in your portfolio. No actions recommended at the moment due to the actions taken throughout last year. Moving on to Michael, multi-asset credit. So this is so credit in general is quite a simple concept. It's lending money to somebody and getting paid back, often with rates of interest that you're happy with for the risks that you're taking on. The risk being that the people that you're lending to don't pay you back. And this is where there's nuances in the class. So multi-asset credit, this is focused more on higher yielding debt, often relative to what we call investment grade, perceived more chance of default, but you get paid a higher level of income in exchange for taking on that additional risk. So it's informed risk managed by the active managers that you employ. So yeah, the benefits being good income prospects and diversification relative to other areas such as equities. As I say, credit default risk is an area that needs to be managed well. This class is currently underweight. There are plans in place to get up to that target weight. These were part way through being implemented in 2024 before some issues with one of the underlying managers at Central Western Asset Management. So whilst they sort that out, this investment is sensibly on pause in terms of additional commitments to the fund. That's expected to be resolved in short order. Central are replacing that the name manager with I believe one or two new managers. So I think it's very sensible to wait and see how that lands before carrying on committing to the class. So the only action we're suggesting there is wait to find out the plans from Central, have a quick look to make sure you're still happy with where they've landed, particular risk and return wise, before a quick review before continuing to make investments in that area. And then moving on to private debt. So this is another area we're suggesting is putting focus over this year with a review. It's about 3 years since we last reviewed this area of the portfolio, so it's probably due, we think. In terms of the overall recommendation, we are suggesting a slight nudge down in the target allocation from 10.5% to 9.5%, so pretty modest. We still like this class in general, but for a couple of reasons, we think it's worthwhile just nudging that down slightly. One being, if we just skip over the page onto the next page with the tables. So you've got 4 main areas as highlighted in the top right where we invest within the private debt world. The top 2 in green are offered by LGPS Central. They've got new launches in this area which you've committed to already. The bottom 2, special situations and distressed debt, they're not areas currently offered by the pool, although that could change in the future should there be sufficient demand. Also, these are the higher risk areas of the private debt portfolio. Excuse me. As you'll see, relatively modest in terms of target percentage, but these are closed-ended investments expected to wind down in the next few years, and with no pool solution at present for where to put that money. Coupled with the fact these are higher risk, higher returning areas that, given the funding position we stated earlier, you might not necessarily need in the portfolio. Also, together with a third area, which is we think there are potentially some new opportunities within this class which could be worthy of a bit of exploration, subject to speaking to the pool as well. We think there's a few good reasons to maybe nudge that target down and review the overall makeup and allocation split of the private debt portfolio.
I just wanted to make another quick point here. This is the third of the changes. So the recommendations are equity, property, and this class. And I mentioned at the start, we've made a few nods to the consultation as part of this advice. We want to use LGPS Central for private debt to the greatest degree that we can, but their range for various reasons is more modest than the wider market, and we don't want to over concentrate in the classes that are available by Central. So we've just nudged down the strategic allocation whilst they develop their offering. and that is the third of the strategic recommendations.
Are there any questions on the private debt side, given this is, I guess, one of the three main areas? Yeah.
No, I don't disagree with the sort of nudge down within there in terms of, take a little bit of the risk off the portfolio within that, particularly relating to if you've got things with LGFS Central. The other comment I'd make with Mayor is you've got, in terms of the schedule of the 17% in category 3, that's quite a lot of interesting diversification. I wouldn't want to lose that diversification within the funds. And that's just the point I would like, because I think that diversification that we have on those sort of esoteric types of investments that you wouldn't be able to, I couldn't buy those in Hargreaves Lansdown with any great ease. That's the kind of bonus that we've got as being a big long-term investor, and I wouldn't want us to lose that within our fund.
Yeah, absolutely. I think that's a key. Yeah, it's a bit of a balancing act in terms of wanting to support the pool, but also wanting to keep that diversification. And yes, some of the areas which are in that category 2 or category 3 do land in the private debt space, such as the bank risk share. You can't get that through the pool. We also diversify generally within private debt by using, as well as Central, we use a third party manager, other third-party managers such as Partners Group. So it's a balancing act. So I think part of the review that we carry out in the year will be in close collaboration with Central for what they can do in some of these different areas, some of these areas of new opportunity which we briefly mentioned but don't really discuss today. I think it's key. Yeah, you're right. It's key that we keep that diversification in the portfolio.
Thanks, Nick. Good point. Good point. Right.
And yeah, just finally, protection assets. I'll spend not too much time on this. As mentioned earlier, there was a big review during 2024 in this area, looking particularly closely at the inflation-linked bonds and the investment-grade credit. Should we top those up, given current conditions? It was decided at that time to not top those up. So the protection assets are ones which we expect to be more stable in terms of the returns that they offer, lower risk in terms of low chance of default, but at the same time lower returns. So we wouldn't want to invest too much in these classes because it wouldn't support the actuarial valuation and the returns needed in that area. Even then, the lower risk in terms of getting returns back, their capital value, their market value can fluctuate quite materially, as we saw in 2022. Things such as inflation-linked bonds and investment-grade credit have sensitivity to interest rates, and as we saw in 2022, their value can move quite materially due to changes in interest rate expectations. But the key to draw out here is just the cash allocation, relatively high at the present time, with good reasons for that. The deployment being a little slow in certain areas, topping up some of the other areas of the portfolio. So a lot of that cash is just waited to be deployed in other asset classes. But what we've suggested is it might be a good idea later in the year to consider what we call liquid holding places. So rather than leaving money in cash for long periods of time, maybe invest it in more liquid versions of the private markets investments that you're trying to move into, in effect. So that's something that we'll look to investigate later on in the year.
Thanks for staying with us. We thought it was appropriate to cover each of the key classes just as part of the work of the committee. We've now finished that, so I'm just going to summarise. This is the chart that I showed you earlier on. Effectively, what we're asking is for the current target, which is the middle row, to be moved to the proposed target for the reasons that I've explained. I've covered the economic rationale for doing so in terms of the views on investment classes. I haven't covered the risk analysis, which I'm going to do briefly now. If you've got rather good eyesight, towards the bottom of the chart, and I'll explain these numbers as well. Any investment strategy can be characterised by the expected return associated with it and the expected risk. And there's some pretty well-established ways of trying to get a handle on those metrics. In short, the current target has an expected level of investment return of 8.4% annualised, and it has a level of investment risk of just over 11%. The proposed target, nudging a few things up and nudging a few things down, has the same level of expected return, which is important because this is a key driver of the contributions when you get to actuarial valuation time. And also importantly, the level of risk is 11.5%. Within the bounds of and the rounding within investment modelling, we are happy to say that the expected return on the risk is very comparable between the current and the proposed strategy. The final point is the current target was ratified through a comprehensive piece of work last year. So in the round, in our mind, our recommendation hangs together.
Hey, thanks very much, Richard and Russell, for that. Roy?
Yes, can I take it back to infrastructure? Just why, do you mind explaining why you don't think there's a case for actually going more into infrastructure as an element of protection if you want to reduce risk?
Yeah, so the weighting to infrastructure, 12.5%, including the Timberland, is relatively material. This is an illiquid, very liquid. These are really long-term investments. We always, even though the fund is a long-term investor, we do have to be mindful of going too overboard with illiquidity. These are assets that you couldn't realise in short order if needed for cash flow purposes, for example. So that not wanting too much in illiquid assets, combined with the fact that we want to keep the portfolio well diversified and in lots of different types of investment to bring that diversification benefit through. We think this weighting is appropriate at the present time.
Yeah, I'll just add to that in the sense that we are underweight there currently, so we are still adding to that asset class, and at 12.5%, it is the second largest asset class weighting that we do have. So when we've got hundreds of millions of pounds worth of money still to add, if you raise that, we'd have to add a lot more at a particular point in time, and then you take on a bit of timing risk as well.
Thank you. Right. Any other questions? No? All right.
Okay, I'll press on. So we've covered the strategic asset allocation recommendations in quite a lot of detail. I just want to touch upon one of the recommended areas to investigate during the year. The US equity market has done 25% in a year. The global equity market has lagged slightly, but it's still done 20% in a year. This is very, very strong performance. This chart here goes back to 1997, and it shows what can happen to 40% of your portfolio if you have a global economic shock. This can and does happen, and the question is when, rather than if this will happen again. This is just part and parcel of the economic cycle. So I'm not going to go through this in detail, but just a few highlights, if you like. That's probably the wrong phrase, actually. But the dot-com bubble led to a 30% reduction in equity over a 3-year period, which is there's got some similarities to the tech situation in the US, actually. You've got the credit crunch or the global financial crisis. It depends on your market, but some developed markets are essentially halved over a very short time frame. And then obviously you've got inflation shocks and COVID shocks. Now, the arrangement to long-term investor, we strongly feel that this class will give you a good return over a 10-year, a 12-year period. The problem with it is if you have a COVID shock and it sells off by 50% just before an actuarial valuation, you have a problem. So the reason for that, and this isn't the only LGPS fund that are looking at this, I know that for a fact, we're suggesting that some consideration is given to offset the, albeit modest chance of a serious run on the equity market, which could really hurt your handsome financial position. And that's the recommendation here. And we're just recommending it investigated, but we have narrowed it down to one particular area that we think is worth looking at. This chart has got too many words on, but I just wanted to reassure you that we have considered a few potential ways of protecting you against an equity market fall. Investing in gold is one example. That would require a tremendous amount of capital, and it wouldn't necessarily work in our assessment. So we've discounted that. We've looked at more complicated strategies using derivatives, which we don't think is consistent with you wanting a nice, simple, relatively simple and long-term strategy. Oh dear, there we go. And we've looked at buying US bonds, which are a very low yielding investment, and you need a lot of them. So what we've ended up with is a recommendation to consider something called equity portfolio insurance. So I'm just going to have a quick overview of that today, and we're just asking for permission to look at this rather than invest in it, by the way. So there's a chart there. I will explain it in words because it's easier to do that. You buy an equity share, so let's say Glaxo, and that equity share can go up, that equity share can go down. It could actually run into a lot of trouble, which is why you've got hundreds and hundreds of equities in your portfolio. Now, the worry is a global recession where all of the major equity markets fall significantly at the same time again. Now, what you can do about that is you can sell equity. That will reduce the expected return. It will have adverse implications for contributions for sponsors. Something we're looking at here is buying some portfolio protection. So in exchange for a relatively modest premium, you will get paid a cash sum if the equity market falls. This is a relatively capital efficient way of protecting against extreme downside risk. And it's not that different in principle to house insurance. So if you own a house, you can buy insurance against there being problems with the building. Most of the time, that will just be a payment that you make, and it's a drag on your personal finances. If you want to think of it like that, you won't be expecting to claim this insurance policy. But if there's probably a significant problem with your house, clearly the insurance will kick in. It's a very similar principle with this portfolio insurance. Another way of saying the same thing in a table, if you look at equity market performance over, let's say, a 1 year period on the left hand side, and let's say you pay a premium for protection of 1%, let's say. If the equity market does very well, if it does 40%, you will effectively get around about 39% because you will have to net off the premium that you've paid that you haven't used. And that it will be a drag on performance. However, if the equity market does fall very considerably, and that's the bottom line of the chart, you can see that that's the point at which the equity protection would kick in. And this could really help improve the financial position of the arrangement in the event of a run on the market. It's probably worth saying at this point about a dozen of the LGPS funds have adopted strategies similar to this over the years. Some of them are in the public domain in accounts. I'm not comfortable actually mentioning them because I want to double check, but I have seen in the accounts of some of the funds reference to these strategies. I think 3 or 4 LGPS funds adopt such a strategy at the moment, and quite a number will be looking at it given what's happened in markets. And a final point before I sort of open it for questions, really, this is another chart, and all we're saying here, and this isn't really clear with the you can't really see the line, but all I'm really trying to say is there's quite a lot of times where the equity market falls 5%, 10%, 15%. If you have some portfolio protection in place, depending on the type that's implemented, it's an offsetting factor. And this is the mechanism by which market falls are protected against within the portfolio. And the more significant the market fall, the bigger the value of having the protection in place. I can't possibly do justice to this in a short session today, and you've already had quite a lot of good stuff from me, but in principle, we think this is something that is worth considering.
Roy.
Just curious as to who's big enough to provide that insurance. Because if we are not taking the risk, somebody must have an awful lot of money to cover the risk for us.
It's just a market, and there's people who are willing to take on the risk for a given price, and there's people who want to buy the protection. It's a very good point, actually, because the price of the protection does vary over time, and that has to be very carefully considered prior to implementation. Just like with house insurance, if the premium's too expensive, you're going to think twice. It's exactly the same here. But in current conditions, for example, relative to history, this sort of insurance is looking relatively attractive.
Thanks. James?
Yeah, I see the kind of the attraction of insurance in principle. I think almost linking back to my previous point, though, to a degree, it feels a bit contradictory. So we've just talked about equities and we're increasing the risk. We're noting the fact that we're in a volatile position. And there's two ways you can manage that risk. We can diversify our portfolio and you can do insurance, and we're doing both. It feels opposite.
Again, that's an excellent point. Effectively, what we're suggesting here is that we think it's appropriate and justifiable to have a little bit more equity and a little bit less property. If you have a little bit more equity, we think it's appropriate and justifiable to investigate ways to given the additional exposure to that class to protect you in the event that we have a recession. So this is unquestionably a risk reduction element, which is intended to offset some of the risks in the portfolio.
Okay. Nick?
Yeah, I agree. It's worth looking at within that. The question I've got is, over what period is this insurance for? Because if we want to say, well, we want to protect ourselves for the next month for a 40% reduction, well, that's probably pretty cheap. If, as we say, actually we want to protect ourselves for the next 5 years, presumably that's a hell of a lot more expensive. And how's that managed?
It's a really good point, and I deliberately have avoided an extra 5 slides on the sort of implementation options, but it is an excellent point. In short, a lot of pension schemes that look at this, they think there's a good balance for 6 to 12 months, 12 months in particular. So that's an area of the market which is very liquid, and what that means is you can get quite good terms for the investment. And 12 months, you can do a piece of work to work out how much insurance you want to buy, and then you're protected, and you don't have to tweak the allocation every 10 minutes. So 1 year protection is the most common. Yeah, just to say, other arrangements that want a lower governance solution, I hate the word solution, but you understand what I'm saying. Some people implement a 3-year approach, which again is very common. And the reason they buy insurance for 3 years is because that matches up with the actuarial valuation cycle. So there's a few different options to be considered.
Okay, thanks, Richard. And presumably these people are providing this insurance. They're not doing it out of their goodwill. They must make some money out of it somewhere.
Yes, yes, of course. So
they're not fools.
No, but it's just the same as any other investment. You make a decision as to whether it's a reasonable value or not. But the people who implement these sorts of things are well-known people. So Schroders are used by one of the other LGPS pools, just to give you an example.
The committee has been asked to approve the changes to the.
Sorry, there's just a couple more. I'm so sorry about this. So we've touched upon that. Russell, are you just going to finish up with the RI, and then we genuinely are finished? Apologies.
Yeah, just 2 slides on this one, and a good news piece. I think really good progress has been made in this area over the last few years. Just picking out a few sort of key things that have happened along the way. So you've added climate awareness to a number of different areas of your portfolio over the last few years. Within listed equity, you've got climate tilts and factors in there, and also within the listed bond space. You've integrated ESG into your strategy decisions. So this is thought about in all aspects of the portfolio and decision making. You have a net zero climate strategy, which has interim and longer term targets, and I'll come on to those in a bit more detail in a minute. You've also added, obviously, climate friendly and climate specific investments to the portfolio. Good examples of this are the net zero power funds, clues in the name really there. You've added infrastructure, further commitments to infrastructure, which increasingly contains large amounts of renewable energy projects in there, for example. And also the timberland investments were mentioned earlier. This is sustainable forestry, clearly, good for the environment and a key carbon sink. Skipping over the page in terms of the metrics, quite a big table, but again, another good news story in our view. So you've actually hit your interim 2030 targets already, which is really good news. A lot of that is down to asset allocation decisions rather than sort of real world reductions. So some of the changes that we've highlighted, that I just highlighted on the previous slide, and just to note that this is unlikely to be a linear trajectory down. So this is something to keep an eye on still, despite the target now being hit in the present year. In terms of where we go from here, clearly some good progress made to date, but more can be done. And this is something that will be considered over the coming months and years. But we've just suggested, given the situation with the current consultation, a bit of a pause on that, and we'll revisit it when we know where the consultation is going. So a bit of a whistle stop tour, but as I say, I think a pretty good news story. You should be proud of what you've done over the last few years.
Thanks very much. Thank you, Russell. So good. So has everyone got any other questions? No. So the committee has been asked to approve the changes to the 2025 target strategic asset allocation as described at paragraph 21 of the report, and agree that the following three views, as outlined on paragraph 22 to 28 in the report, be undertaken and presented to the investment subcommittee for consideration. I'll have to make the recommendation. Can I have a seconder?
Yeah.
Thank you. Is that agreed? Yeah. So that's unanimous. Yeah. So on to item 8, which is the draft responsible investment plan for 2025. Which is covered on pages 113 to 126 of the agenda. Kat Toohey, Responsible Investment Analyst, is introducing the report. So over to you, Kat.
Morning, members. So this is a kind of continuation of the RI plan, Responsible Investment Plan, that you've had every year for I think 4 or potentially 5 years now. So the purpose of this is to kind of seek your approval of this plan, and that supports the fund in being able to further improve the management of responsible investment risks. For the fund, the term responsible investment refers to the integration of financially material, environmental, social and corporate governance factors into all of the investment processes. So this has relevance both before investment decisions by the investment subcommittee, and then so during and kind of ongoing investments as part of the fund's fiduciary duty. As members will be aware, is quite distinct from ethical investment, which is an approach in which the moral persuasions of an organisation take primacy over investment considerations. As I kind of said, so we kind of consider this in 2 key areas. So as part of our investments, so Russell highlighted the kind of investments we've done on net zero, so forestry, net zero infrastructure, and of course our passive equity, low carbon transition funds. And then, of course, as part of stewardship and governance, this is what committee get on a quarterly basis, so updates from our managers, LGS Central and LGIM, on kind of the stewardship and governance they're doing on our behalf to make sure we have considered voting of shares, and we're engaging with our underlying companies as part of managing these risks. So This plan builds on the four previous iterations, so and it improves on this approach. So take into account all of committees' comments and kind of areas of interest, as well as engagement with Central, and kind of best practice across the kind of LGPS and wider. So as kind of was set out in the Fit for the Future consultation, that has a number of proposals. While the proposals say that the fund will retain control over its ESG matters and responsible investment, we'll obviously need to see how that kind of pans out due to how, I guess, those factors can be implemented in practice with Central's role. So just to pick out some of the kind of key areas in the RI plan, and always welcome comments from members of any areas of interest throughout the year. Obviously things kind of pop up pretty quickly. So we'll continue to have the quarterly manager presentations to committee, and this will kind of also be from Central, given their role, and focusing on performance and the wider ESG considerations in the assets. We'll also continue to engage with our investment managers, and we have a questionnaire we've done for 2 years now. So continuing those processes to see they're kind of giving appropriate overview to climate risk, and kind of engaging with the underlying companies. We'll also in June have some high-level net zero climate strategy proposals and considerations to bring to you. Obviously approved the net zero climate strategy in March in 2023, so that's due for review and kind of come to committee in 2026, so bring some kind of high level kind of review considerations for you in June. We'll have the normal climate risk management report in the December meeting, see where we can enhance that to kind of include further asset classes and kind of show I guess what's driving kind of these changes in climate metrics. I'll leave it there for any questions on the plan.
Okay, so committees, we've had some good results on this area. Has anybody got any queries or questions or express any? I mean, we have masses of metrics and there's more and more coming through. And I think its development of those metrics would give us greater insight in what's happening. We know what we're doing as making representations to the companies we're invested in, and number of resolutions that we've opposed or put forward objections to. Does anyone have any comments or questions? I think this is an area which isn't going to go away. I'm well aware what's happened in the US, and that doesn't really solve anything because it is for the future we're going here, and it's just going to be increasing focus. Does anybody? Dan?
Yeah, thanks, Tom. I can't. Yeah, I think it's a very good piece of work. We are heading in the right direction, certainly on this. I think we have hit the sort of next target. I think but I think as mentioned earlier, these things can go up or down potentially. I think we've got to be wary of it. Just see that as a sort of minimum target and try and make sure we've got a bit of a buffer zone in that for the 2030 target, isn't it? So but yeah, it is good. We're heading in the right way. It's, compared to where we were sort of 3 years ago, it's good sort of news. To say there are other factors. I think we've just got to look at the what we can do and what happens in the US. That's really a bit down to them. We just got to do what we can do on this.
Okay, thank you, Dan. Has anybody got any other queries? No? All right, so if that's the case, the committee has been asked to approve the Responsible Investment Plan 2025 attached as Appendix A to this report, and the committee doesn't have any specific areas which aren't already highlighted that they want to be brought forward. So I'm happy to move the recommendation. Can I have a seconder? Is that everybody in favour? Yeah. So that's agreed unanimously. So thank you, Kat. So the next item is item 9, agenda This is on the pension fund training needs self-assessment report at pages 127 to 136. We've made some significant progress on this over the last 12 months. So, Kat, over to you to present the report.
Thanks. This is another one of the reports that kind of get every January. So this is kind of giving committee an update of the training needs assessment that's been undertaken, and then also progress against the 2024 training plan that was agreed, and the progress against that. So as members will be aware, the policy for training is especially important for committee, given the distinction of fiduciary duty owned to the fund compared to kind of members and officers' normal business. The fund is also treated by investment managers as professional clients, and so we have to demonstrate that we kind of comply with the Markets in Financial Instruments Directive, and part of that is showing committee are at a sufficient knowledge level across the committee. And there's of course other factors, and recognises changes in membership cycle, in membership due to the election cycle. So it's another reason we kind of have to keep on top of where the training is for the fund. This has also been kind of reiterated within the recent Fit for the Future consultation, which will probably look to kind of define training requirements on committee stronger, but at present, I think we're very well aligned to where it looks like government will go. So before Christmas, we circulated a training needs assessment for all members based on the areas of appropriate knowledge and skill from CIPFA, CIPFA's guidance. As of 15th January, I've had 8 of committee members, 8 out of 12 committee members completing them. So one of the recommendations just asks that members complete it as soon as possible if they've not already done so. And that feeds into the training plan, which we'll be able to circulate and kind of organise in a similar way to we have the 2024 training plan. As members know, last year we set out that members should complete all Hyman's Aspire training sessions within 6 months of appointment. I think the most committee members are compliant, so just asking that the remaining members kind of just get up to that compliance, just because I think that the Hyman's Aspire gives a really good level of like base knowledge, and it seems like members it worked well in terms of having the in-person sessions as well as being able to do it in your own time where that was necessary. So we're just asking members to get up to compliance. This is anonymised in the report, but we've circulated a version that has kind of names against it. And it's just that reminder that this will be, as at the 31st of March 2025, we'll have to record this and then publish it in the fund's annual report. So it'd be great to see that compliance in line with all of the kind of requirements for training.
Thank you, Kat. So, yeah, we've made significant progress, and there's a reason we have advisors, because this isn't straightforward stuff, but we've at least asked to have a base knowledge, and I think that's what we're really asking for. So, has anybody got any queries or questions? No? Right, so the committee members are asked to complete the training assessment if not completed by, well, today actually, but as soon as possible. And members not in current compliance with the training policy are asked to commit to progressing the completion of the Hyman's Aspire modules, noting that a record will be taken as at the 31st of March 25 for the fund's annual report. So I propose that. Is that it? You have a seconder? Yeah. Everybody happy to go with that? Yeah, that's agreed. So that concludes today's meeting. It's the members are asked to note the date of the next meeting is the 14th of March 2025. There are no urgent items, so the live stream will now end. And thank you all for your questions and comment. There seems to be a good understanding of what's going on, and thank you. Richard and Russell, for coming along and explaining it to us. All right, so that concludes the meeting. Thank you all.